How is the market reacting to this? Of course, if jobs creation is slowing down and unemployment is increasing, that could certainly look like a negative picture for the economy. And one of the pieces of data that we like to look at as far as how market prognosticators or investors are looking at the market is how much premium is being demanded for investing in corporate bonds versus government bonds. And what we can see here is the spread, so the difference in yield that you would get by buying a corporate bond, which carries credit risk, meaning that the company can go bankrupt, versus the government, where theoretically a government cannot go bankrupt. If that spread is really tight, meaning that the premium that you're demanding for that corporate bond is low, that means you take some level of comfort in knowing that there's not a huge economic risk that could cause companies to become more risky to own. And right now, we can see that the spread on investment grade bonds and high yield or junk bonds is close to all-time lows. And what that tells you is the market is not necessarily worried, at least at the time, for how the economy is moving forward, or at least the expectation of how the economy is moving forward as it relates to the jobs market. Now, that doesn't mean that cracks couldn't form in the future, but right now the bond market is telling us, or at least the corporate bond market is telling us, that there's not a lot of worry there, because if there was worry, we would see those spreads really increase and spike. We saw that during COVID right here, and we certainly saw that during the great financial crisis back in 2008 and 2009.